Aloha, I'm Joanna Amberger with 3 Financial Group. I've been asked a lot recently about how the stock market will be affected in a recession. So I'm going to answer this question in 2 parts. First off, do we know if we're going into a recession? Recessions are notoriously difficult to predict, and part of the issue is that there really isn't a standard definition of a recession. A simple rule of thumb the media likes to use says a recession is 2 consecutive quarters of declining GDP. Now, the official definition of a recession is a little more complex, and it says a significant decline in economic activity spread across the economy lasting more than a few months, normally visible in real GDP, real income, employment, industrial production, and wholesale retail sales. Whew, that's a long one. Now, because the definition of a recession is backward-looking and uses many different data points, we don't really know if we are in one until after it has already started. Economists and pundits love to predict recessions, but are generally terrible at it. Forecasters tend to be too optimistic about forecasting growth and a little slow to predict or identify recessions. Now, the second part is, how do stocks perform during a recession? The stock market performs poorly before and during a recession a little more than half the time. In 45% of the recessions since 1953, the stock market has actually returned positive rates of return before and during. Now, after periods of recession, we typically see much stronger trends for growth in the market. The chart you see shows data for each recession since 1953, which you can use for reference. Now, by the time a recession is upon us, the market has already declined, meaning prices have already fallen. And the market following a recession tends to see rising values, rewarding those who stay the course. So what are our takeaways? Recessions are a normal part of the business cycle. Trying to time the market typically leads to making emotional decisions at the wrong time, and most people are terrible at it. Usually when people try to time the market, they buy high and they sell low. They lock in losses after the market has already declined and wait until the coast is clear and prices have gone back up before buying back into the market. Now that, buying high and selling low, is a great way to erode the value of a portfolio over time, not build one. Now, instead of trying to guess what's going to happen in the future, we prepare in advance using asset allocation and diversification as our key strategies to manage risk. Now, this does not mean your portfolio will never decline in value, but we try to mitigate the bumps along the way and spread the risk out over many different investments. Now, of course, I know it isn't easy to watch your portfolio go down at any time, but I encourage you to remember your long-term plan. Now, your final tip, turn off the news and ignore the media pundits. They are there to prey on your fear and greed and to make money from your eyeballs on their advertisements. Now, check out my blog for other financial tips and reach out to connect if you have questions.